Welcome back to page 6. Okay, this is chapter 6, page 6, and we are going to start doing the schedule, and in fact, this is our new schedule. And some of the other calculations will have extra little pieces in them from our new schedules we made. So, the unrealized realized profit schedule, or intercompany profit schedule, is what we're going to do first. Now, I want to write 2 little reminders to you. So 1, always use seller's gross profit rate, and 2, on Connect and on the problems, markup of selling price equals gross profit percent. Okay, so we're going to have some sections. We're going to have a balance section, a tax section, and an after tax. Kind of not in a straight line, but we'll go with it. Okay. And we're going to start with ending inventory. So, still in the circle. Okay, so this, we're always going back to this main sheet here. Okay, so we're going to look for anything that says unrealized or realized. So nothing here until we get here, number 2. Upstream unrealized, still in circle, downstream unrealized. So these are the 2 things we're going to put on here. So let's just do them in order. We'll do the upstream first. Upstream unrealized. And I'll just put page 4 so you know. Now, that's, if it's upstream, who's selling? So the sub is selling. So we're going to use subs GP percentage. So in the little Lego terms, the sub would have sold this and put their profit on. We've got to take this profit off. So that's what we're calculating. We're calculating this profit. We have to take off that because it's sitting in the parent's inventory. It wasn't sold on outside. So look back at page 4 and find the sub's gross profit rate. And double check, you guys, this is the second most common error. The first one is getting unrealized and realized mixed up. So 30% times 1,000 gives us 300, and then leave space in here. Then tax is 40%, and net income is 180. That's just multiplying. So take a second, make sure you know where those numbers are coming from. So we're using the subs gross profit rate because it's upstream. So now we need the downstream unrealized, which is in point 4. And that's use parents gross profit percent because they're selling. So in this one, the parents sold and they put their little blue gross profit on it. But it's just sitting in the subs inventory. It didn't make it out of the circle. So we're saying, we can't recognize this. We've got to take it away. That's what we're trying to do. So, looking back on point number 3 on page 4, again, this 4, It's 25% times the 700. So we get 175, we get 70, and we get 105. Okay, so that's the easy part. Now we've got to decide what we're going to do with the accounts on the income statement or balance sheet. So this profit, it's the gray one because it's upstream, we've got to get rid of this profit. So we're going to make cost of goods sold go up, because that will reduce net income, which is what we want to do. We have to take away some of the parents' net income because what they sold to the sub didn't go through, or to the parent. It works the same way for both. So cost of goods sold goes up, and inventory, and this is on the parents' books, goes down. Because right now on parents' books, the sub sold and put their profit on it. So this is on the parents' books right now for this first one. It's sitting there. But that inventory is too high. It shouldn't have the gross profit, and the income shouldn't have the cost, or shouldn't have as much net income. Okay? Instead of doing sales or net income in total, they decided with cost of goods sold. Because it's sales for one, cost of goods sold for the other one, it's sold again, so we just adjust that. Okay, so let's just try this again. Cost of goods sold goes up to decrease net income. And then the same thing's going to happen here. Cost of goods sold goes up. Inventory goes down. Okay, now the tax. So income tax expense, is going to be ITE. Income tax expense, ITE. Make net income go down, what's tax expense going to do? Go down, because you don't have to pay as much tax. Bearing in mind, you guys, this is just on our consolidated statement. Income tax actually takes each entity by itself and figures out tax for that. Okay? And deferred income tax will go up. It's always the opposite. Now, you learned deferred income tax last year in 316, so you can look at it and figure it out, but that's a handy little rule to remember. Okay, so same thing here. Cost of goods sold is going up. That means net income's down. So ITE goes down, DIT goes up. And overall, net income is going down. So, these ones are for use on consolidated statements. And this part is used for calculations. So, just a general rule when you're adjusting your statements is always adjust income statements. Only adjust the balance sheet if the asset liability is still there. And we'll see that in the next year. Okay, so anything from here that's real or unrealized, and right now all we're doing is inventory. It's inventory sold from the parent or the sub to the other one, and it hasn't left the circle, so we've got to take off that top layer and subtract it. And the way we're subtracting it is we're increasing cost of goods sold so that your net income goes down. Okay, and then along with this change, the net income changing, ITE goes down and DIT goes up. Okay, let's go to a calculation that we're kind of familiar with and add some things on. So, calculation of consolidated net income year 4. So, as we know, it's for the year, not cumulative. And this is a new one, after tax. That's why I said use this end for calculations. After tax, that's the numbers we need to use when we're doing our calculations for this and retained earnings and NCI. Okay, so the calculations, maybe I should write that down. Net income, retained earnings, and NCI on the balance sheet. So this is another common mistake. People don't use the after-tax amounts. They try and use these ones. So just be careful. So we have to start with parents' net income, and it's on page 5. And it's 4248. Now, we've learned this. Remember, we put the parents and adjust, subs, and then adjust. So then we take off less dividend from sub. And that's page 4 or 5. And that we already calculated was 81. Now, this is our new part. We have to look at this schedule up here, and anything that's downstream is going to come up in this section because it has to do with the parent. So downstream, the parent would be selling, this is where we'd be at. So we're going to plus or minus, as we need to, downstream, realized, unrealized transactions. So, looking at this, which one's downstream? Well, it's this one. Now, there's 3 numbers here. Which one should I take? Always after tax, so I'm going to put the 105. Now I have to figure out, I'm just going to make a note that's after tax. Am I going to add it or subtract it? Am I increasing net income or decreasing it? Well, decreasing, because it shouldn't have been realized. That profit shouldn't be there. So net income's going down, so it's going to be subtracted. And that's parents adjusted net income of 4062. Okay, now let's do the subs portion. Same idea, we're going to put the stuff we already know in, right? Because this, we already knew that, this is just new. So we're going to add subs net income, also on page 5. So go ahead and find it, because sometimes trying to find the information in these questions is tricky. Now, what did we usually do? We did plus or minus changes in AD, which is also on page 5. So let's look at page 5. Here's page 5. This is year 4. These are the changes. So we've got 650, and they're making net income go down. So it's 650. Net income's going down, so it's negative. Remember we said there's no tax effect? If there was a tax effect with this, you could have 2 more columns and put tax, after tax, and do the exact same thing as you did here, okay? Okay, good. So we've got that. So what are we missing? So we knew this already. What's our new part? Well, we're missing the upstream that the sub's selling. So new plus or minus upstream unrealized realized transactions So looking here, we need the upstream. And it's unrealized, so it shouldn't be there. So this is the sub selling to the parent. They sold them the block inventory and they put their profit on it. But because the parent didn't sell it outside the circle, we can't have this profit, so we've got to take it off. And if we take off the profit, what happens to net income? Goes down. Okay, so we got three numbers here. Which one do we use? Always after tax. So we've got 180 and net income's going down. Net income's going down because the profit shouldn't have been there. It was still in the circle for consolidation purposes. So when I say it shouldn't have been there or it's wrong, you guys, I'm not talking on their separate entity statements. I'm totally talking for inside the circle. Okay, so we add that up. We get 850, and that works out to 4912, and that's our consol income. But what do we have to do after that? We have to split it up between the parent and NCI on the income statement. So we have to do this one first, then the parent. So NCI, what's their percentage ownership? 10% because we own 90. Times, which of these numbers do we use? This one. Because NCI doesn't own any of the parents, so we don't care. That's why we separated downstream up here and upstream down here, because the sub-selling, that belongs to NCI. Parent selling, NCI doesn't need anything to do with that. 10% times 850 is 85, and that means the parent gets 4912 minus 85 is 4827. Now, I hope I'm not going too slowly for you guys on this. If I am, just speed it up, put it to 2 times or whatever, and hopefully that'll help you. I just wanted to make sure, because this is the trickiest part of this entire course, this and chapter, I wanted to make sure you got it. Okay, I'll see you in the next video.